right. Good morning, good morning. It's 9 o'clock. And we are, again, we're thrilled that you're here. I'm Brad Pappas, Executive Director of FEI Twin Cities. And our next session is going to cover the future of payroll. Attract and retain talent with on-demand pay. And this is presented by our partner, PNC Bank. And we are thrilled to have our speaker today, Dave Frascona. He's the Senior VP and Product Innovation Manager from PNC. Hey, Dave.
Thanks, Brad.
Thank you.
Good morning. Good morning, everyone. I'm going to try to avoid using the mics, and if everybody can hear me in the back, then I can stay away from that. We've got a good intimate setting here. That's great. I do have quite a bit of material to run through, so I'll probably ask you to wait till the end for questions, but we should have plenty of time to do that. It's great to be here this morning. My name is Dave Frascona. I'm with PNC Bank. I want to thank FEI for having me here today, as well as my colleague Neil Murphy with PNC, our local treasury management officer. I've been with PNC Bank now for 4.5 years. I've been in the innovation space that whole time, so for treasury management, corporate and commercial innovation, my team and myself were responsible for bringing new corporate products to PNC and to our clients. And on-demand pay is something that we've been focused on for really since I joined PNC 4.5 years ago. Really trying to understand that product, what it does, how it helps people. I'm going to talk a lot about that with you this morning today. Prior to working for PNC, I was with Bank of America for about 16 years in a commercial and digital channel space there. Working with various AP, AR, treasury management solutions there with Bank of America as well. So with that, we'll go ahead and jump right in. I am from Charlotte, North Carolina, so happy to be in Minneapolis this morning. All right, so in terms of what I'm going to talk about here regarding on-demand pay, we're going to start off sort of with what's happening in the marketplace. We'll talk a little bit about specifically what is on-demand pay, how does it work, benefits of it to both you, your corporation, your company, and your employees, common employer goals that come with on-demand pay, and as you're thinking about launching a program, what are the things that you should be thinking about? So, with that said, let's sort of jump right into what's happening in the marketplace. So, let me before I do that, we've got a nice small intimate setting here. How many of you are familiar with on-demand pay, earned wage access? Who sort of knows what that is or has heard about it before? Okay, so not that many, only maybe 10% of the group, a little more. So good, I'm glad I can sort of just talk about something that's a little bit novel this morning. So, why is there a need for on-demand pay? So one of the first statistics I have here is that 22% of U.S. adults are unable to pay their bills on time and in full, right? About 50% of all Americans are check to check. Almost a quarter of them are struggling to pay their bills on time and in full, right? What that means then is that there are other product solutions, other things happening in the marketplace to help offset that problem, right? So that's covered with banks in many cases, inadvertently through overdraft fees, and then there's payday loan type items as well. So let's sort of start with overdraft. So PNC is really excited about taking on financial wellness behaviors, and as a result, PNC, along with other banks, last summer we've removed NSF fees completely. So we still have overdraft fees, right? Overdraft is the difference where the bank's extending you credit to cover a purchase. NSF is where there's not enough funds there, and it's insufficient funds, it's not going to clear. So there's different things there. So PNC has instilled something called low cash mode that basically can warn a consumer when that happens so that hopefully they don't go into overdraft. And again, we've removed NSF fees. So banks are aware. However, the statistics is here, and it's stark, right? The average overdraft fee is over $33 each time that happens. So it can certainly take a bad problem and compound it, right? We all understand that. So one of the other solutions is, generally speaking, think of payday loans, right? So you might look at that statistics on the screen and say almost 300% APR Dave, you're crazy. Like, nobody's offering 300% APR. So I mentioned that I'm from the Charlotte area, and I'm not embarrassed to say that I started my career in South Carolina in consumer lending areas where, think of sort of strip mall loan stores, right? Starter loans, title loans, those move up into equity lines, things like that. However, if you think about a starter loan, right? If you've never heard of a starter loan, this is a real product that people with no credit have to go use. And a starter loan might start off with an amount of, say, $60, right? Somebody's going to borrow $60, and that's probably to cover a bill or whatever it might be. Their payments on $60 might be 5 payments of $20. So you're saying, all right, well, that's, not too bad, $20, 5 months. But do the APR on that, right? Now you come up with something that's right there in the neighborhood of 300%. Title loans are insane. Check cashing places, right? You think about those types of stores, those types of shops, right? They're holding your check for 2 weeks, and they're going to give you less than the check says, right? That is not a check cashing place. That is sort of basically a payday loan. So those products are out there, and I think the point here, everybody, is there's got to be a better way, right? There's got to be a way to access your money in advance of payday, and that's what sort of on-demand pay is all about. So the other sort of trend that's happening in the marketplace, especially when you think about millennials and Gen Zs, we would all agree that they expect instant gratification, everything now, right? Instant affirmation, transparency into what's happening. A couple of really simple examples that we all know from our personal lives, right? Let's take Domino's Pizza, right? Maybe not the best pizza in the world. However, you can order it. No offense to anybody who loves Domino's. But you can order it. You can sort of see that your order has been received. It's processing. You can see that somebody is pressing out the dough for your pizza. You can see it's in the oven. You can see it's on the way to your door, etc. The best example is Amazon, right? Amazon has sort of taken something over the past 10 or 15 years where you can place that order, it's delivered, you can watch every hop, thanks to the delivery systems that we have today. You can see every hop of where your package is, all the way to where it's on your door, with often a picture of the package sitting on your door as well. So instant gratification, and I think that, going back to Amazon, now they've taken that a step further where you think back to when you maybe first joined Prime, right? You got a guaranteed delivery of 2 days or 3 days. So in the Charlotte area, I'm sure it's probably true in Minneapolis, right? If you're near a distribution center, you can order something at 10 a.m. and it's on your doorstep at 4 the same day. It's unbelievable. So I'm not here to advocate Amazon. However, it is certainly about instant gratification and sort of behaviors that we see in our everyday lives become expectations, right? And that same expectation is transferring over to payroll as well. So to think a little bit about these age groups specifically, and by the way, I think it's fair to say that those expectations I just talked about are not specific just to these age groups, right? We all live those, we all have those experiences, and that's the same expectations that we have. But if you think about millennials, an age group of 27 to 42, Gen Z, that age group's about 11 to 26, right? These are basically your workforce of the future, these two groups. And when you think about on-demand pay or earned wage access, and I'm going to use those two terms synonymously, guys, today, these age groups already know about this product, right? They already use it already, or they're very interested in it. Over 50% in both cases for these age groups. The prior group talked about layoffs earlier. So this particular slide that I have talks about when someone loses their job or they leave their job, right? Did they quit or were they laid off? So I've got a 10-year span here that's aging on me just a little bit in terms of this slide. However, you can see that there's a trend happening here. Maybe some of this could be related to COVID, but you can see it's pretty linear. If you focus sort of down the middle of the slide here for layoffs, so from 2011 to 2021, layoffs, in terms of folks who lost their job, right, 44% of those people were laid off. Counter that with in 2021, that is now 25%. So a decrease of 43% over that 10-year span in terms of people being laid off. On the contrary, though, the bottom line, the quits went from about 48% of the people, right, almost half the people quitting on their own, to now almost 70%, right? So an increase of 44%. So, you know, I'm sure that the Salo team probably has interesting facts about this and the why, but, you know, from my perspective, it's about folks taking control of their jobs, of their future, of their careers, and making sure that they have the flexibility, the benefits, right, all the things that they want in today's workforce, or to build their careers. And these are from, you know, the Bureau of Labor Statistics, these particular stats. So not many of you had really heard about on-demand pay or earned wage access. So let me sort of talk a little bit about what is it. So on-demand pay is about employees accessing their pay as it's earned, right, instead of waiting for payday. So it's their earned pay. What it is not an employer advance, right? It's not a payday loan, and it's not an early direct deposit. So let's talk about early direct deposits for just a second, because I know that's even been in the news here a little bit, I think. It's a new product that is similar to on-demand pay, but it's not quite the same thing. So an early direct deposit basically means if you were to get paid traditionally every 2 weeks on a Friday, right, that payday of Friday might move to, say, Wednesday, right, 2 days early. There's marketing for this. I think Capital One has a program out there. They talk about get paid 2 days earlier when you open a checking account, right? So I would argue that, although still a great product, all it really does is give you a new payday, right? Instead of getting paid every 2 Fridays, you get paid every 2 Wednesdays. So it's really not the same thing. And that works because what happens is when the payroll files are sent to the banks on, let's say, on Wednesday, right, the bank's able to receive that. They're able to understand how much you're going to get paid on Friday, and they're very comfortable extending that sort of credit position out 2 days earlier because they've got the file, they know what they're going to get from their client, they're able to give you the money 2 days earlier, you're good to go. And that's all really dependent on when they receive the file. So if the payroll provider sends the file on Wednesday, that's going to work. You're probably going to get paid 2 days earlier if your bank has that program. If it doesn't have that program, or if the file comes on Thursday, it might be 1 day, or it may not be any time at all. So it's really a different product. So where on-demand pay is different is it's gonna directly challenge the concept of getting paid under fixed pay period times, and instead giving access to that pay as you earn it. So what does that mean? So here's an example, right? So let's say that there's a 2-week cycle, and the average or the end pay of that 2-week cycle for this person is going to be $400. Okay. Now the person works, say, 3 shifts through week 1. They're looking at their app that converts their shifts into an available balance in terms of how much money they can draw down, sort of what a portion of their net earnings that might be available. They're going to say, you know what, I need to pay my cell phone bill. I need to extract $50 early before payday. So they're going to get the $50 less any fees, and there's different programs. Different programs offer different fee structures, right? Sometimes there might be 0 fee. Sometimes for an instant transfer, same-day transfer, there might be a fee. PNC Earned It charges $3.49 for instant transfers and $0 for next-day transfers, as an example. Then when payday comes, right, they're going to still be owed an additional $350 of their $400 on that Friday. So they'll get the $350 on payday just like they normally would, and they would be made whole across that whole 2-week cycle to receive the whole $400. So they didn't receive any less pay, they just were able to access some of their wages as they earned it each day, right? Punch the clock, suddenly that 8 hours turns into available pay that they can draw down off of. 2 shifts, 3 shifts, 4 shifts, whatever it is, that balance is going to go up and they're able to draw down a portion off of it. Different programs will offer different amounts in terms of what's accessible. It might be 100% of net earnings, it might be 80% of net earnings, 50%, it really just depends on the program. And specific to PNC's program, we offer 80%. For our product, it's called PNC Earned It, we offer 80% of those earnings. And we do that because it's about making sure that we're not inadvertently giving loans, right? This is not about giving loans, this is about money that's been earned, that can be accessed. So let's dig a little bit deeper to understand how this works. And what I'm going to talk about right now is called the direct deposit model, because earned wage access has different funding models, different types of capabilities in terms of how the programs can work, how the flow of funds can work. So there's employer funding models where basically the employer is controlling the requests and the remainder pay, and you would have to do all of the reconciliation, right, which you don't want to do. There's wage deduction models, very similar. There's also debiting models where other companies are sort of not a part of the payroll process, but they understand that somebody's going to get paid. They'll give them an advance, and then on payday they'll debit back. I like that model the least because that feels the most like a payday loan, and it also creates a whole bunch of concerns around debiting those funds back, creating overdraft or other issues. So I don't like that one. But when PNC took a look at on-demand pay, this direct deposit model we really appreciated the most, and I think you'll see why as I sort of talk through it here. So it all starts off with transmission of HR and timekeeping data. So the HR, hours worked, payroll amounts, right? There's different files from your payroll and timekeeping systems that are going to be sent over to your on-demand pay vendor, right? As those shifts are worked, like I talked about, they're going to get converted into, in step 2, an available balance, right? So 2 shifts of 16 hours might turn into $100 net available balance. So what's interesting about this is very frequently our clients and users of this particular program, we're going to transmit this data whether they've enrolled or not. And a lot of times people say, well, why would you want to do that? Why would you want to understand that information or have exposure to that information if somebody hasn't even enrolled in the service yet? Because this is offered as an optional benefit, right? That the employee can either decide to enroll in or not, right? Not everybody has to use it, obviously. But here's the deal. You only need this type of a product until you need it. And there can be very timely scenarios where you want to enroll, you want to access funds, and as soon as you enroll, if we have the data and we can understand where you are in your pay cycle and what your worked pay looks like, we can translate it into that available balance immediately after somebody enrolls. So that means that they can enroll and immediately see they have an available balance, and they can request those funds right there. So think about somebody being in a checkout line, recognizing they probably don't have enough money to cover the $200 worth of groceries in their cart. There's $50 short. They can enroll, get the extra money that they need based on timing of their pay. Believe it or not, that's a real thing. But step 4 here is about seeing that balance, requesting the first transfer. So that's sort of everything that I've talked about to this point. Now, where the direct deposit model starts to change is on payday, again, the employer is going to transmit what's the final pay, right? The $400 gets sent to the on-demand pay vendor, and then they're going to send out let's call it the remainder pay, right? So they took 50 in the last example, the remaining 350 is going to be delivered on payday by the on-demand vendor. So sort of the magic here is what happens in terms of how do you pay back the on-demand pay vendor is when direct deposit information has been redirected. So by enrolling in the product, the direct deposit, instead of going directly to the employee, it's going to go to the on-demand pay vendor, right? Because your payroll is going to run the way it normally does today, and then on-demand pay as a solution will just sit on top of it. So the on-demand pay can do the reconciliation, it can receive all of the regular payroll check, the net pay, and it has taken care of distributing the remainder pay, as well as earned wage access transfer requests, so that you don't have a change to your company, to your payroll, to your cash flows. However, the employee has access to their funds. Okay, so how is this? Yeah, go ahead.
If I can have a single question, so yeah, quick. Just to confirm, in this model, the funds from the employer are still transmitted as normal to the institutions, right? On payday or on that.
That's
So
right.
the employer is not advancing the funds at the beginning as part of the program.
Correct. The only time the employer is engaged is step 6, and that's when payroll runs as it normally would.
And step 1, because they have to.
Correct. Yes. There's a data transfer that could be through API, file transfers, depends on the
Is
program.
there generally a cost to the employer for this?
So the way that these programs are typically structured, pretty much across the industry, at least now, is that the employer has zero cost. So when we offer the product, it's zero cost to the employer. Fees to access money are on the employee side. So that's where if an employee wants an instant transfer, I want the funds right now. And we use products such as real-time payments, Visa Direct, MasterCard Send to move those funds in seconds into that consumer's account, right? And that there'd be a fee for that type of a product. Next day ACH, zero cost, at least for us, but no cost to the employer. Some employers might elect to help offset some of those costs if they want to, but it would be optional.
Okay, thank you.
Yeah, great question. Okay, let's talk a little bit about how on-demand pay helps you, your corporation, and your employees. So Claire, John, Dave, they talked a ton about recruiting, attracting talent, engagement, right? We'll talk about that. Let's sort of start with the payroll side of the house. So what's really interesting and unique about what this product can do is if you think about that sort of punching in and out, finishing a shift, right? You're not going to see new available balance funds until you completed your shift and punched the clock, right? Because then the file transfers are going to happen through API, whatever it might be, and then that person's going to, literally see their available balance increase, right? They're going to be able to see how much money they earned by completing that shift. So that means the time clock compliance is going to be increased, right? If you miss punching in, then you're not going to see that change, or punching out. Digitization of pay, reducing paper checks, right? I think paper checks are going away. Most companies, some don't offer it at all. Some are absolutely trying to get out of that business. Maybe it's prepaid cards, maybe it's something else, but sort of making your company more modern in terms of digitization of pay, better offers of how you deliver pay, and reduction of paper checks, right? So big things there for payroll, as well as some cost save, getting rid of paper. On the human capital side, more so, turnover. So PNC partners with Daily Pay. That's our vendor in terms of how we help deliver PNC Earned It. So some of their statistics, we've had our product out there since early last summer. So we've got about 10 clients on the product today. Daily Pay has hundreds of clients. They have household name brands that you would know. But nonetheless, so they've done a lot of statistics, and I'm going to share some of them here. But turnover. So in terms of having on-demand pay or not, a 50% average reduction in turnover for those that are using on-demand pay. Recruiting, being able to make this a part of your recruiting materials, right? We offer on-demand pay. Help fill positions faster. Employee engagement, right? Once people sort of understand, get better visibility into their pay, they're motivated to work more shifts, potentially longer hours, as a result of using the service. So that's more on the corporation side. How does it help your employees? So we talked about the problem of paying bills on time. We talked about more than half of Americans live paycheck to paycheck. So this really sort of helps solve a lot of those problems, right? So removing the need for employer advances, those types of requests, right? Removal of predatory loans that I've talked about, payday loans, dependence or reaching out to family and friends, right? Horrible experience for anybody that has to do that, right? Bring back dignity, right? Bring back a way to sort of control that yourself. Financial stability, and with the point of being improved financial wellness, better credit scores, happier employees. So that impact to your employees can be pretty substantial. So one thing that we have seen in terms of how this product is used is it's not about going out there and having purchases of passion, if you will, of desirable items. Instead, it's really about paying bills, avoiding late fees. Right, 78% of the earned wage access requests are to pay bills. In terms of other impacts and how that can reflect back to your company, 73% of users said that the opinion of their employer has increased. Right, they're more motivated to come to work. They have less employee absenteeism as a result. On this next particular slide, talk a little bit about sort of the, again, payday loan fees, and as we have had our partner take surveys on this, they've come back and said about a $612 savings in payday loan fees. So I'll tell you what we didn't do to come up with the $612 number, right? We did not go across the country and come up with an aggregate amount of what payday loan fees might be in a year. That was more of a subjective question answering, now that you're not using payday loans anymore, how much do you think you saved? So, however, what I think is really a better statistic about where the $612 number came from is that of about 1,700 survey respondents that were polled, 66% of those people were already using a payday loan type product. So a lot of people, when we talk about this product with our clients, they say, I hate this, it's going to get my employees into more trouble than they're already in if they're currently struggling. And I think that goes back to my point earlier around, they're already using something, right? So this gives them a new option, a new, better way where receiving a portion of their pay a week earlier might mean paying rent on time instead of being a week late on rent and getting hit with a bunch of late fees. Back to sort of the payday loan fees, this statistic, 70%. So people are not having to use that product in many cases, 70%, when they're using on-demand pay instead. All right, less financial stress, motivated to come to work, improved financial health. So some of the common program goals that we hear from our clients when we're talking to them about on-demand pay, earned wage access is, here are some of the things that they tell us that they're looking for when they use this type of a program. So one, it's a competitive labor market. We talked about that earlier, right? So you want to stand out as an employer of choice. Also, it's sort of a new world, right? There's a gig economy out there. Thanks to Uber, Lyft, right? People are finishing a drive shift and getting paid, right? Those expectations that I talked about, right? That's sort of becoming an expectation potentially of workers, especially as we've seen in quick service restaurants, right? So McDonald's, Sonic, Burger King, Taco Bell, they have this, right? If you don't have it, you're in that business, how are you going to attract that talent, right? I like this one a lot, avoiding a delay or a change to payroll frequency. So we've had a couple of clients specifically say, I want to go from weekly payroll to every 2 weeks, and this is a great way to help offset that, right? Because it's going to create a little shockwave. People get used to getting paid how they do, and this is a way where you can say, well, you've got this optional benefit. If you do need to access some funds earned in advance of payday, you can do it. Paying new employees faster. So I've got a really quick and fun anecdote here. So working for PNC, I was on my way to Pittsburgh, and I was in an Uber and started talking a little bit about what I did for PNC. And it turns out that the Uber driver was a school teacher. And it was, I think, early October timeframe. And she had told me, wow, that would have been a great type of product for me. Here's what happened. So the school district had all the teachers come back to school, come back to work 2 weeks earlier. So let's say it was supposed to be September 1st that they would normally come to work. They had to come mid-August. But guess what? Their paycheck cycle, their first check cycle, didn't move. And with it being, a county job, they get paid once a month. So she didn't get her first check until the end of September, having worked since, mid-August. So there's lots of different, ways that this can really help your company, your employees, without having to change payroll. Stabilizing workforce. Another thing we've heard is, I talked a little bit about employee advance requests. So we've had clients say, we've had a lot of employees come and say, hey, can I get an advance on my pay? But chances are you don't have a process to do that. This client didn't. They ended up having a very subjective process. It's sort of like, oh, I know John. I think John's good for it. We'll give you $100 early. Somebody else, I don't know Dave. Sorry, Dave, you're out. Right? So it's not a good position. It's not where you want to be. So getting rid of employee, or having a process, I would say, for employee advances is another one. And again, back to financial wellness, right? To try to help your employees with that as an alternative benefit that you could offer. So I'm going to talk a little bit about sort of launching a successful program, if you were to want to consider one in the future. So it sort of starts off with planning and thinking through what are your goals, what are you trying to accomplish, right? So coming up with your planning model, what are you trying to get out of the program? How are you going to communicate the program to your employees? It does not need to be an annual enrollment cycle to offer on-demand pay. You could do it at any time in the calendar year. Your employees could enroll at any time, or if they don't like the program, unenroll. I would say the majority of the programs out there are structured in that way. But nonetheless, you're going to need to communicate to your employees about it. There's going to need to be some level of training, right? Whether it be through the payroll staff to help explain a little bit about how it works, as well as to managers in terms of who the employees might be asking questions about the service. And then once you have launched, right, this is designed to be a 24/7 product, right? At 11 o'clock at night on a Saturday, if there's a problem, right, and somebody needs to access their funds, and there's a problem, you don't want them trying to call your payroll company because, number one, pretty much guarantee nobody's going to pick up the phone, and two, it's just not the business that you're in, right? It's not what you want to be doing. So having a support team is really important. And then I think to sort of come full circle is a reporting cycle to understand how the product is used within your corporation. Are you getting the success that you're looking for, right? Are you saving money on staffing, recruiting, retention as intended? I'll take a minute to talk a little bit about communication, because communication is a key factor to driving adoption, right? And if you don't have adoption of the product, then you're not going to reach your goals. So we've seen on average about 30% adoption. So 30% of your staff is going to actually use the product. So that starts off with communicating, right? So if you communicate, let them know that there's a service out there, an optional benefit, then they're going to have better adoption. It can be part of your new hire package, right? It can be part of your marketing in terms of from a recruiting perspective. Also using digital channels, whether it be company emails, whether it be personal emails. Lots of these services, including PNC Earned It, have ways to really manage that for you, right? In terms of taking that need of blasting out communications to let people know that the service is available and taking that on for you. On-site marketing, right? If digital channels is not a good option, maybe it means hanging a poster or something in a break room, right? In a lunchroom for maybe manufacturing, or it just depends on the market. But it's really about increasing adoption to offer the product to your staff, right? Better pay experiences for those staff that want to enroll and want to use the product. So I'll sort of wrap up here with what are some of the key things to think about and consider in the totality of a program. So there's sort of three main areas here. Program features and maturity of the product itself, operational disruption to you and your company, and lastly, support, which I talked a little bit about already. So one, in terms of the direct deposit model or other models, what's the system integration challenge for you, right? Does it mean connecting your payroll service to an API, file sharing, depending on who you use? It might be as simple as connecting to a widget. For example, ADP, right? With ADP payroll, you can connect to a widget, have file transmission happening all day. Other payroll systems, there's different ways to do it. A lot of API connectivity, a lot of file sharing. And it's not hard to set up. So what's the integration challenge? Compliance expertise. Like I'm not trying to come up here and kid you, right? This is a novel product. It's relatively newer in the marketplace. So understanding changes to payroll laws, what's happening from a regulatory perspective, right? That's going to be really critical, right? You don't want to inadvertently get yourself in trouble. I talked a little bit about the amount of net available pay, right? Can an employee access 100% of net pay? Some products only offer, say, 50%. So, that can make a difference, right? If you, in the spirit of the program, as you've worked, this is your money, you should have access to it. But at the same time, there's got to be some guardrails and safeguards in place to make sure that you're not inadvertently overdrafting. You don't want that to happen. Ease of use, quality of the product. So we took a look at Daily Pay's product specifically for a long time. In fact, from a compliance, UDAP, regulatory perspective, we took the product, we smashed it on the floor, and we put it all back together. And here's why. Because they're a fintech, right? They think like a fintech. They don't think like a bank. They don't think about how fees are presented to a consumer. They don't think about that type of risk, right? So we wanted to make sure we were comfortable all the way across in terms of how the product is offered, and the experience that the user is going to have, especially the employee. So, I think it's fair to say that although banks are starting to enter this space as well as payroll companies, it is newer, and as you look at the different earned wage access vendors that are out there, they're all in a different state of maturity. So for example, rather than a fee model, some of them have a tipping model, saying, hey, I'm not going to charge you anything, but if you had a great experience, then tip us. So that doesn't sound great to me, and a particular company that was doing that even had a little bit of pay-to-play happening, right? The more you tipped, the more access to more wages you got, the more services you got offered. I think they have, unwound that. However, it is a space where people are trying to think out of the box, and sometimes you think a little too far out of the box, right? Immediate access after enrollment. So I talked about that before, right? So you have not ever used the product, but you've enrolled, and now you've got access to those funds instantly and immediately. So operational disruption. So shift gears now to the payroll system. So I talked about sort of this direct deposit model being layered on top of existing payroll, right? That means you don't change your payroll cycle. It means you're not changing how you pay your employees. It just means that the funds that you pay on payday get redirected to a new direct deposit account, right? And that's through automatic file transmissions that are going to make those changes for you. So it's not a bunch of calls coming in saying, hey, I want to enroll, change my direct deposit account. No, it just happens on its own in the background. So minimum impact to payroll process, as well as thinking about impact to your cash flow, right? So we've got financial experts in the room today. That's a big thing, right? You don't have to change your cash flow cycle. You don't have to change your access to cash because of this. And then any ongoing data management needs, right? What do you have to do? Do you have to do any reconciliation on your own? Do you need to understand that somebody, Joe got paid early, Steve didn't? What do I need to do, right? With this type of a product, you don't need to do anything. It just takes care of itself. So the last thing here is support. So different vendors are going to have different levels of support for you. So that could include launching the program, marketing it to your employees, having marketing materials that are ready to go, co-branded with your name on it, and all you have to do is distribute them or look to the vendor to distribute them for you. Training of your staff, right? That doesn't mean everybody needs to be an expert, but just in case a manager gets a question, hey, what is this thing? How does it work? They can generally answer it, as well as the payroll team. I talked about 24/7, 365, right? You don't want to be answering those questions in the middle of the night or middle of the day, or frankly, period. So let the person who's running the program do that for you. And then lastly, visibility into those reporting capabilities, right? Is the program working for you? Do you have adoption? Do you have the statistics to make an educated decision on, is this the right program? Is it achieving what you want to for you and for your employees? So that's what I think about in terms of the total program success. So everybody, that's pretty much everything that I wanted to cover today about on-demand pay and earned wage access. We've got, looks like 10 minutes for any questions that you might have. We'll start, we'll go right to left.
Right to left. That's your on the right.
Well, I'm sorry, I'm right to left.
Audience left. It's a Minnesota stop sign.
So 2 questions. One, what are the fees for the employee? And is there an average of what that person's salary is that you're typically seeing in the market using the service?
Yeah, so we'll start with fees. So fees are, for our particular program, we're charging $3.49 for an instant same-day transfer. For a next business day transfer, it's $0. So for our product specifically, in the marketplace, that can vary, right? Sometimes there's payday card solutions where you can transfer money to a payday card, and everybody's got to, you can't offer a product and not have a revenue stream, right? So the payday card models make money off of interchange, off of those payday cards, so you have to move the money to a payday card, and that could be a free transfer. In our case, we've seen that the majority of the transfers that people make are using the instant transfer, so as a result, there's a revenue stream to cover the product. However, what's great about it is, if you can think at least a day ahead, it means that this can be the kind of service you can offer to your employees at no cost to your company and no cost to those employees that use it in that manner. So there is absolutely a way to do this fee-free. In terms of who uses the program, so our program is eligible for employees that make up to $100 an hour or $200,000 annually salary. And it is not just about a minimum wage worker. So although you might see some of that more so towards the lower pay salary amount, that's not always true, right? And it's really because even though you might think that that's where people are going to use the product, when you think about half of Americans being paycheck to paycheck, right? A few days earlier for a salaried employee is absolutely something that we're seeing in the marketplace. Great questions. We'll go there.
So I heard you were taking a haircut in your program, so that there's only 80% in advance. I could see it in instance maybe somebody put in incorrect hours, they didn't work it, or there may have been some fraud. Where's the risk of fraud, I guess, in this pipeline?
Yeah, really good question, because fraud's on everybody's, it's top of mind for everybody right now. So the way this program works is the change to the direct deposit information in terms of how earned wage access requests are going to get received, either through push to a debit card or push to a checking account, direct deposit. That's all going to be controlled by the employee, and they're going to have two-factor authentication. They're going to control those changes on their own. So from a fraud perspective, one, it's about making sure that the funds are going to the right place and that somebody's not getting spoofed or hacked with those changes. So, protections at the application level. And then the 80% is about, what if there's an unexpected garnishment, right? What if there is an error in payroll? So different companies have different ways to handle that, because the truth is it happens, right? Either there's been an error in payroll and somebody was going to get overpaid, and that means they've drawn down more money than they got on payday. So with our program specifically, we're never going to go back and debit the employee. And I think that most of you in the room, at least those familiar with HR, know that you really can't do that anyway without their consent. So, but regardless, for this particular program, we would never want to debit an employee. Instead, when their next paycheck comes in, there's an opportunity to recover any shortage, and that's it. If there's not enough funds available to recover the shortage, PNC in our case would eat that. But I think that's really goes back to trying to have some type of a buffer here, and that's why we chose the 80% number. Good question.
Two quick ones. First, can any enterprise of any size or scale or financial stability engage with on-demand pay platform, or are there certain prerequisites with the organizations that you serve?
Yeah, it's a good question. So as we're sort of just starting off our program, and as being a channel partner to Daily Pay, and really sort of there is a point of diminishing returns, right? Because if only 30% of your staff is going to adopt it, right? There's no point in giving it to 20 people and 5 enroll, right? It's just it's going to be an expense rather than a benefit to the on-demand pay vendor. So to answer your question specifically, today we have a requirement of at least 400 employees to enroll in the service.
Got it. And you kind of dovetailed into my next one, which was this 30% adoption example that you gave. Is that a threshold that kind of determines this is a fit or not? You need to kind of poll your audience to say, what's your appetite for your consistent communication up front about the program? Do you think this is going to be appealing to a certain subset of your employees, or if there's only 2 in the company that are doing it, is it still worth the exercise? But it sounds like
I think that's actually more of a natural and organic adoption, right? As word sort of spreads through a company, that becomes the average adoption amount.
Sure.
Some companies don't get there. We've seen, like, this is super popular in quick service restaurants, manufacturing, healthcare, big one, call centers, right? There's tons of different markets, and I don't think it's not necessarily about certain demographics in all cases, but I think as long as there's value and benefit to the employee group, whether there's only 10% adoption or 30% adoption, like that's good for the company, right? Because the people that want to use the product, understand it, know it, are comfortable with it. Those that don't see a need for it, that's fine too, right? Just don't enroll. Yeah, I think you had a question.
Well, kind of got an answer, but I also have another one. So do employees have a bank account with you for this program?
They don't have to.
Okay.
So this works with any bank account. So that's the beauty of it. So even though we branded it, PNC earned it in the case of our program, it's designed to be bank agnostic, right? Whoever they bank with today, just load that information in, and that's where the funds are going to go to. And that's true. You know, just think of your direct deposit. It's basically the same scenario.
You may have mentioned this before, but just with the payroll providers, most of us kind of use payroll providers.
Sure.
Do they have competing products that they're not maybe adoption of this? Is there any issues there?
So there's going to be different adoption capabilities depending on payroll provider. Some of them are more sophisticated, where there's going to be API integrations that sort of like if you're using ADP, check the box, do some testing, it's done, right? There's a direct connection to ADP, PeopleSoft, WageWorks, things like that. If it's with a smaller provider, right, you can set up file sharing through SFTP, whatever it might be. Did that answer your question? Okay. Some of the other payroll providers are starting to offer this too. So ADP has a solution. WageWorks is, and by the way, they happen to partner with DailyPay also. Additionally, WageWorks is looking at it. Other banks are offering it as well. US Bank is active with PayActive, who's a competitor. So it's absolutely out there in the marketplace, guys. It's something that I think is worth your time to think about for your employees, and is it the right fit? So with that, I'm being cued to wrap it up. So I hope that was helpful, everybody.
Thank you, Dave. Thank you, PNC Bank. All right, folks. Wow, you have 10 minutes. That means 9 minutes to be back in your chair. Thank you.